Sometimes to understand the future, you have to look back at the ghosts of the past. And there's this one story about an economic collapse so fast and so total that it holds a really critical warning for Kenya today. This isn't just a history lesson, trust me. It's about a future we absolutely need to avoid. Okay, so picture this. It's the mid-1990s. The Asian tiger economies, they're the talk of the town, the envy of the entire world. They were posting unbelievable growth year after year. Seriously, they looked completely unstoppable, like they had found the secret formula for success. And then, just like that, it all fell apart. The collapse wasn't slow, it was sudden, it was shocking, and it sent shockwaves through the entire global financial system. That feeling of invincibility, yeah, it was just an illusion. The fallout was just immediate and absolutely brutal. I mean, you're talking about stock markets in a total freefall, national currencies becoming practically worthless overnight, and the entire banking sector, well, it was teetering right on the edge of a complete shutdown. It was pure economic chaos. So the big question is, what happened? What was this hidden flaw that brought these economic giants crashing to their knees? Well, the answer wasn't what you'd think. It wasn't a typical market crash. No, it was something buried much deeper, right inside the companies themselves. The real problem was something called corporate governance. Now I know that sounds a little academic and dry, right? But think of it this way. It's like a company's conscience and its rulebook all rolled into one. It's the system that decides how things are run, who's in charge, and crucially, how honest they are about it. When experts sifted through the wreckage of these economies, they kept finding the same common thread: incredibly weak governance. We're talking about rampant cronyism, making huge loans to the CEO's brother-in-law, not because it was a smart investment, but just because of who he was. Everything was hidden behind closed doors, so nobody knew how bad the rot was until the whole building came down. And this quote from the analysis really nails it. It exposed a simple but really harsh truth. Economic growth without strong governance is basically like building a beautiful skyscraper on a foundation of sand. It might look impressive for a while, but it's fragile, and it's just waiting to crumble. Okay, so this is the part where a story from 1997 suddenly becomes incredibly relevant for us, right here, right now, because we have to ask the tough question: are we seeing an unsettling echo of these exact same problems in Kenya today? Just look at the parallels here when you put them side by side. The source material points out the same red flags waving today in Kenya that were waving in Asia back then. Cronyism is pervasive, there's a serious lack of transparency, and accountability is weak. This isn't just theory, it means major public contracts might go to connected insiders instead of the companies that can actually do the best job for the best price. It creates a system that rewards who you know, not what you can do. And what's the result of all that? Well, you get a totally uneven playing field. It suffocates real competition, it snuffs out innovation, and ultimately, it puts a hard, artificial ceiling on the entire country's economic potential. And let's be really clear, this isn't some abstract problem for economists to debate. There is a very real and a very high price for doing nothing. Good governance isn't just a nice-to-have feature, it's an absolute economic necessity. Because here's the bottom line: money flows where it feels safe. It doesn't matter if it's a local entrepreneur starting a small business or a massive international fund looking to invest. Capital only goes where there is confidence and trust in the system. That trust, that is the absolute bedrock of all economic growth, period. And that confidence, it's incredibly fragile. You know how the saying goes, it can take years and years to build, but only seconds to destroy. Once investors get spooked by corruption or instability, winning back their trust is an uphill battle, to say the least. And the Asian crisis showed us just how terrifyingly fast those dominoes can fall. It can all start with just one major scandal at a big company or a bank. That one event triggers widespread panic. Investors, foreign and local, start pulling their money out, and suddenly all new investment just freezes. The entire economic engine grinds to a halt. This is where the risk gets really personal for everyone. Think about Kenya's biggest national ambitions. Big goals like Vision 2030, huge infrastructure projects like new railways and ports, and most importantly, creating enough good jobs for a growing young population. All of these things depend on massive, sustained investment. Weak governance puts all of that capital and all of those dreams directly at risk. So, all of this brings Kenya to a critical crossroads, a real fork in the road. The country faces a clear choice: either ignore the lessons of history and risk a similar crisis, or learn from the mistakes of others to build a much stronger, more resilient economic future.
And really, the path forward is pretty clear: strengthening oversight, demanding real transparency, and fighting back against cronyism. These aren't just about ethics or doing the quote-unquote right thing. They are fundamental, practical requirements for a healthy, growing economy. They are economic necessities.
And this final quote from the analysis really says it all. The stakes are just too high for half measures. Real, meaningful reform isn't just an option on the table to be debated. It is absolutely essential to securing the nation's entire economic future. So that leaves us with the one ultimate question. The lessons are right there, written in the painful history of what happened in Asia. The parallels are unsettlingly clear. The path to a stronger future is defined. The only question left is, will Kenya learn from it?